Hey everybody, and welcome to Stock Abilities. In this video, I'm going to be doing something a little bit different. I'm going to be going over the best ETFs to sell in 2020 and beyond, and that's going to apply to pretty much any year that's quite volatile. And a lot of people don't know some of the stuff I'm going to be covering, so make sure to watch through the whole video to get the whole impact of why I'm recommending to sell these kind of ETFs and not hold them into the end of the year or further years, despite whether the market goes up or down. I'll be breaking that down, so make sure to listen through, comment below your own input on the video, and we're going to jump right into it here. The biggest ones you shouldn't be holding into 2020 and beyond are the 3x leverage or even 2x leverage or any kind of leverage ETFs, because leverage ETFs are not exactly ideally suitable for a longer term holding. There is things like decay and volatility and things like that, and the wrong kind of volatility can crush those options. Compounding can cause large losses for 3x ETFs during volatile markets. Best example, 2020. I'm going to show some charts here in just a little bit. They're also leveraged using weird derivatives that can cause other varying risks that you might not be aware of. And then, being as they are a fixed level of leverage, 3x ETFs can fall completely and lose almost everything with a big enough drop on that underlying index. And I'll show you some examples here in just a second as well. And if none of these happen, over time, there's higher fees, higher required margin fees, margin maintenance, all those kind of fun things, and these are risks that happen. So, think of a 3x leverage ETF like an option contract, because they mix in futures, they mix in swaps, they mix in options and all these other things that create that underlying volatility and that liquidity, and that liquidity vanishes. They just simply pull out, and then the particular ETF just crushes. So there's a lot of risk in a 3x ETF. There's a lot of risk in ETFs in general too, with that that high expense ratio aspect, as mentioned earlier, with the high cost. Just for them to keep these going, it's just not worth it on a long term basis. If you're swinging an ETF, that could be good. If it's a 3x leverage ETF, that's fine. Long term on a 3x leverage, not the best idea due to the high risk associated. Some examples of a 3x leverage here is a nail. Nail has been very good on the year, but to hold it on a long term basis would be kind of nonsense, being as that it ran up from basically 6 or 7, I guess like 7 or 8 in March, all the way up to the 60s. And, over the past years, it does this a lot. It spikes up really high and then it dumps back down again and then it runs back up. And that's because it's more of a seasonal based stock. You don't want to be holding an ETF that's 3x leverage that needs volatility. That means that Home Depot is going to have to continue to go up quite drastically in order to maintain a nails push upwards on the market. Same with Lowe's here. Lowe's, same thing, hitting an all-time high. This is a very, very big spike. That's why Nail is up so much, because this is the biggest spike that Lowe's and Home Depot have had in many, many years. Previously to that, they didn't really go up that significantly. They went up and down kind of on a rotational seasonal basis. But this is the biggest season up because everybody's at home and they're working on home improvement projects, and then summer's coming around. But then you got to factor in that into the end of the year, Lowe's and Home Depot aren't going to be shopped at as much. It's going in a winter. It's going into colder seasons. Fall is a good season right now, but then when fall ends, it's like future guidance. Who's going to be buying those supplies? Not very many people. So going into some other different ones to consider here that you might want to avoid, biotech. Biotech is a very seasonal one, especially on election years. They come out with a new virus every election year, so there's something to keep in mind. Not saying that it's purposely done, just saying that this happens every single election year. That viruses come and go, and a seasonal biotech, it's up and down. There isn't a steady stream of biotech. There's some companies will push out a vaccine. It's a big buy the rumor, sell the news event. You have these different clinical trials that go out throughout the year. Later in the clinical trials, the less likely they are going to be to pass, the less likely they are going to be to have future growth in that regard. So you're playing the volatility of that buy the rumor, sell the news. So when companies start getting vaccines, things like that, there's not going to be that much of an interest in those particular companies as an individual basis. Maybe on the sector as a whole, but not so much on the individual basis. Now, other ones to keep in mind, healthcare, same thing. Oil and gas. Oil and gas is volatile. It has spikes up and down. When a given index, as mentioned earlier, 33% drop in just one day can cause these literal options to crush, or these literal ETFs to crush into nothing. Now, this is just 3x leveraged ETFs, but you might want to be careful when you're doing just ETFs in general because they're based on the movement of the underlying sectors. So that is something to keep in mind. There's a lot of different things here to consider, but we're going to just go over just some brief ones here just through the video to give you guys an idea of ones you should be avoiding. Biotech, as mentioned, very, very seasonal here. You have the ups and down, but right now you're at a very, very huge peak from just a 1 year movement. So you have basically it went up from 44 to 79. And then if you look here into the historical data here, probably not exactly ideal to be utilizing a Google chart for this, but in just 2020 of July, it was 80, and then it dropped all the way down to 62 because the volatility died down a little bit. It spiked back up. But as you can see, it is a very, very seasonal stock. It has spikes up, and then it has spikes down, and up and down, and up and down. We're at kind of a peak here in literally its entire history. So this is not a good ETF to be holding right now. Going into another one here, oil. Very simply, when the underlying collapses too much, the ETF itself can get crushed as well. As you can see here, it was pretty stable for multiple years, but then 2020 came in and 2018 and so on and so forth, and it's been pummeling itself down into next to nothing over these years. It might have a big boost up from here, but is it really viable to hold this kind of ETF into a longer term basis? Probably not. Same thing with real estate. Real estate, you're coming into, spring, fall, so on, and you're going into winter. Is there going to be that much real estate bought during the wintertime? Probably not. It falls into a very similar case. But, this is one of the more stable ones, so it's not exactly a terrible idea at this point. You might see a little bit more of an upturn, but at this point, we're going from a bottomed out 29-ish to almost 60 plus here coming up soon. Is it going to hit the 85 or so? Probably not. You might see mid 60s and so on and so forth. But the move on this one is pretty much done. There isn't a whole lot else to it. But coming back full circle here, you have a 3x leveraged ETF is a very, very bad idea. ETFs in general aren't exactly a bad idea, but when you add that leverage, you add decay, and you add a lot of different things to it. There's a beta valuation as well, which I didn't highlight earlier, and the beta valuation is kind of how much that ETF might react to a given play. But the short answer is when the volatility gets crushed in a stock, an index drops enough in that particular market, you're going to have a significant drop on your holdings as well. And this applies to nail. This applies to, all these other ETFs out there. They all have impact utilizing those derivatives in association with all of that. So essentially, your losses are magnified, but your gains could be magnified too if you catch that right volatility. In Nail's case, probably the best ETF out of them all, it's run up a lot. But from a swing basis, you're at a peak here. You're hitting a resistance point from 2020 that it was at, and it's barely hitting that, and its holdings are up even higher than they were back in 2019. So you got to think that even with all this volatility and all this boost up, it's still not quite there yet. Some of these ETFs will never hit their highs again because that's just how they work. That's how these 3x leveraged work, that they're very, very dangerous in that regard. So that's pretty much summarizes what I wanted to cover in this video, just as a